Hey everyone, and welcome back. Today, we need to talk about one of the biggest and most powerful companies in the entire AI and tech space, Broadcom. Because today, Broadcom did something completely unexpected. It reported strong earnings, and then its stock got hammered, dragging down the entire tech sector with it. This has everyone asking the big questions. Is the AI boom finally slowing down? Have the expectations for these stocks just gotten way too high? Let's break it all down. So, here's what happened. Broadcom's shares fell around 5% today. Now, a 5% drop on any given day is significant, but for a company that just delivered strong revenue results, it's a huge surprise. The initial reaction from most people was confusion. Good earnings should mean the stock goes up, right? Well, not this time. According to major outlets like Reuters and the Financial Times, the drop happened because investors completely fixated on one specific detail: profit margins. Even though Broadcom gave upbeat guidance for its future revenue, the market heard something it really didn't like about how much profit the company will be making on that revenue. This is the key to understanding today's chaos. Broadcom essentially told investors that as it sells more and more AI chips, its overall profit margins might actually go down. Why? Because the margins on these super hyped AI chips are lower than the margins on some of its traditional software and semiconductor businesses. Think about that for a second. The very thing driving all the growth AI is also less profitable per unit than their older products. This was the warning shot that caused a panic. In a market that has been priced for absolute perfection, where every stock is expected to deliver flawless growth, even a tiny hint of shrinking margins can trigger a massive sell-off. Investors have gotten used to a simple story: AI equals explosive growth and explosive profits. Broadcom just complicated that story by adding a dose of reality. Several sources are now describing today's reaction as a clear sign that the AI hype might be cooling off. A news summary on TradingView put it perfectly. They said the stock tumbled because Broadcom didn't deliver the kind of explosive, over-the-top AI commentary the market was desperately hoping for. They called it a hype meeting reality. In other words, investors were strapped in, ready for Broadcom's management to come out and promise another year of non-stop, off-the-charts growth, riding the AI wave into the stratosphere. Instead, what they got was a much more level-headed, realistic outlook. And traders, who thrive on momentum and hype, didn't like that one bit. They wanted rocket fuel, and Broadcom gave them a sensible long-term business plan. Now, this wasn't just a Broadcom problem. Investopedia reported that the entire AI trade was hammered today, with Broadcom leading the charge downhill. As soon as Broadcom showed weakness, it triggered a chain reaction of selling across all the major AI names. This shows just how important Broadcom has become as a bellwether for the entire industry. When a giant like this stumbles, the market doesn't just see it as one company having a bad day. It starts to worry that something bigger is wrong with the whole sector. So, today's story is much bigger than just one stock's price movement. It's about a fundamental reassessment by investors. They are starting to question whether the AI sector can really keep delivering this mind-boggling growth quarter after quarter without any hiccups. Business Insider ran a headline saying Broadcom had become the latest victim of sky-high AI expectations. The market wanted growth to accelerate forever, but Broadcom's management signaled a more normal, steady pace of growth. And in this environment, steady is seen as a disappointment. Seeking Alpha described the market's reaction as disappointing, even though the company actually hit its key financial targets. So let's be crystal clear about the takeaway here. Broadcom did not miss its earnings. It didn't fail to deliver. What it missed were the unrealistic, almost impossible expectations that investors had priced into the stock. The company is doing great, but it's not doing magically perfect, and that was enough to cause the sell-off. The ripples from this spread far and wide. Sherwood News reported that the concerns around Broadcom, along with some similar caution from Oracle, were enough to drag down the entire AI trade and push the broader stock market into the red for the day. This just goes to show how interconnected everything is. It's also worth noting that this isn't happening in a vacuum. there's other background noise around Broadcom that adds to the general sense of uncertainty. For example, there are ongoing antitrust concerns in the EU over its massive acquisition of VMware. Some critics are still arguing that regulators made a mistake by approving the deal in the first place. While these aren't today's headlines, they contribute to a narrative of a company facing multiple complex challenges. So, to wrap this all up, Broadcom didn't deliver bad news. It delivered good news with a side of cautious realism. And that dose of realism was enough to spook a market that has been running purely on hype and momentum. With AI stocks now under pressure across the board, investors are left asking a crucial question. Has the AI sector finally peaked? Or is this just a healthy, and frankly much needed, cooling off period before the next leg up? The next few weeks will be critical in telling us where this market is headed. What do you think? Is the AI bubble popping, or is this just a bump in the road? Let me know your thoughts down in the comments. Thanks so much for watching, and if you got any value from this breakdown, make sure to hit that like button and subscribe for more updates. See you next time.